This is the Friday, June 20th, 2014 version of the Market Plus segment. Joining us now is Tomm Pfitzenmaier. Tom, welcome back.
Thanks, Mike.
We have had a number of questions from our Twitter followers. Most of them, of course, are concerned about the weather. We talked about it on the show a little bit, the impact of the flooding that we're seeing in northwest Iowa, parts of Nebraska and South Dakota. And Adam in central Iowa is just curious, how widespread of an area are we talking about? We've heard a lot of the news in the Corn Belt. Is it just localized?
It is just localized. And the people I've talked to up in that area say, yes, there's going to be some damage, but the water's going to go off fairly quickly. It's going to reduce the crop size. But like I said on the show, you had this big drought area supposedly from eastern Nebraska into western Iowa that's been eliminated. You got all the rest of the Corn Belt that's been getting nice, timely rains. So I don't think the net is to me, an potential increase in production. Now, if it's your field and you've had some damage, not good. But for the overall impact, I just don't see it as being anything that's going to damage the crop. It was enough to spark the corn market to rally, and you see the pictures, and everybody in Chicago runs out and buys corn because of it. But in my mind, that's just creating an opportunity.
Now, this flooding, though it is localized, have we seen much of an impact on transportation of old crop corn and beans coming out of elevators, South Dakota? Nothing.
No, I don't think there's been any impact there at all.
Okay, all right. Now, we do have a question from Tommy in Independence, Iowa, taking a look at soybeans. Tommy's curious, with such a huge price difference between cash and new crop beans, what's going to happen in that market as time goes on?
Well, I alluded to it on the show. The problem is we've been talking about this short situation in old crop beans now, well, basically ever since Christmas. So you got to think that all the end users have probably kind of figured out how they're going to get by. By all accounts, most of them have bought out through the second or third week of June. And at some point, when you combine 90 million bushel of imports from Brazil, the plans that they've already made, probably some cancellations are on the horizon at some point here. You put that all together, and do you really need to rally old crop beans? You got the funds have had a big long position. They've been liquidating. That's why you've seen the big drop in the old crop. And I just think eventually that's going to get worked out. It's not a surprise anymore. Now, it is going to make that June 30th report pretty critical, because that's going to tell us there is a possibility that last year's crop was underestimated. That's another explanation. If they come up with another 20 million bushel, then all of a sudden, maybe not such a problem. If this thing was really as tight as they say, we'd have a really tight basis. They'd be scrambling, doing everything they could to get their hands on beans, and it's just really not happening to any great extent.
All right. On the new crop side, what do we think we're going to see on the cash side of the bean market there?
I think eventually you're going to see futures work down toward $10, another two and a quarter down from where we're at level, which is going to be $9.50 cash beans. I think as we go into the fall, acreage is probably going to be up. The way it looks, South American crop was very good. We got the potential for an El Nino coming in, which that has been diminished a little bit, but could benefit the crops in August, which is very critical for beans, as we all know. So I think we've benefited from the unwinding of those spreads, given new crop a kick. But if you can see corn drop 88 cents, which it did in a fairly short period of time, that sure wouldn't be a big stretch to see beans drop $1 here. If the weather kind of starts to straighten out and that July mess kind of gets straightened up.
And that makes 12.25, as you were saying on the show, 12.25 to 12.35 look like a pretty appetizing range, with 10 on the horizon potentially.
Absolutely does. I think a guy would be crazy to not at least take a piece of that. Now, if you think I'm completely crazy and that we're going a lot higher, that's fine. Don't sell a lot, but at least do something.
Get something booked.
Yeah.
Now, Rodney in Edgar, Wisconsin is curious. Again, we touched on this a little bit on the show in the feeder cattle market. He's curious, how much more upside is there for feeder cattle and also for feeder hogs?
On the feeder cattle, I think you have to decide what kind of assumptions. What is that feeder market assuming already? Is it assuming $4 cash corn, or is it assuming something less than that. If it's assuming $4 corn and we've got another 50 to 75 cents down in corn, then that adds probably another $10 onto the feeder market. If you think the fat market's going to stall out here at 50, then feeders are probably if you think they can work up to 165, not a projection on my part, but a possibility, then that takes, I think you could say feeders up in the 220 to 225 range is a possibility.
But we're going to have to see big moves on the part of either corn or fat cattle to really justify a change.
That's my opinion, yeah. And the feeder pig market is basically kind of the same way. The profitability and what those futures are going to offer people are probably going to dictate how high that feeder pig market can go too.
All right. All right. Now, before we let you go, there's been a lot of talk over this past week with the situation in the Middle East, in Iraq, and the crude oil situation. What is the market anticipating for crude oil? Do we expect this to be relatively short-lived, a pop and then back down?
The problem, and the reason the market's nervous is that Iraq is the second largest OPEC producer. And at this point, those oil fields are controlled by the Kurds, who are, somewhat friendly to us, and it's not a problem. The fear is that those are lost to the extremists and the terrorists, and get cuts off a big chunk of crude. If that happens, then I think you got crude prices up to 120, maybe 125. Domestically, it's not going to affect us as much as it had. We're at 27.5-year highs in our domestic crude production. So that has had has sort of a tempering effect on the impact to us, the domestic users of energy. But that crude oil market, if things start to get dicey over there, has some pretty good upside potential in it yet, I believe.
And that could put a damper on folks' restaurant spending, or high-priced protein demand. It could have a ripple effect.
It could feed right into being a problem in the pork and beef side.
All right. Well, Tom, thank you so much for coming by and sharing your thoughts this weekend.
Thanks, Mike.
Thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so, and we'll continue to get expert analysis right to you. Thanks for watching, and have a great week.